My title is, of course, the new Commodity Supercycle. So let's take a look at what that is. And my view is what we're looking at here are two secular bull markets, two megatrends at one time for two distinct reasons or two distinct driving factors. And to kind of preface this, I believe this is a unique position. We have never seen this before. We have seen bull markets in various individual commodities for very distinct reasons, but now we have two very broad-based trends that are driving bull markets in commodities across the board. Now, the markets that I will focus on today are monetary metals, really just gold and silver, and base/energy metals, and that can run the gamut from lithium to cobalt to copper in particular, and a number of other metals that are being driven by important trends today. The reasons or the factors that are driving both of these markets are monetary debasement and supply constraints, long-standing supply constraints that are running headlong into really soaring demand, some of the steepest demand curves, in fact, that we've ever seen in commodity investing. Let's look at the first one here, monetary debasement. And to start off with, I'll ask the question of our audience. What is the US dollar going to be worth, in your view, tomorrow, next year, or 5 years from now? Well, we have a pretty good idea, and that is less. It's going to be worth an awful lot less. It's going to buy an awful lot less. Its purchasing power is going to be much lower than it is today. This chart goes back to 1965. Not coincidentally, that's the year that they took silver out of US coinage. And we see that, and this chart isn't even updated, this only goes up to 2022. But we see that over that time frame, the dollar lost 90% of its purchasing power. Now, you might think that's unusual, but it really isn't in human history. It has happened over and over again. One example you see in this chart, that's the decline in the silver content, which is the decline in the value, the purchasing power of the Roman denarius. And we see a quote here from the great orator Cicero, saying things that a lot of people are saying today. The public debt should be reduced, officialdom's arrogance should be tempered and controlled. Essentially, we need to get our fiscal house in order. But again, this is something that has happened over and over in history. They didn't listen then. They're not listening now. In fact, some things never change. Throughout the history of human nature, one thing remains consistent, that leaders will overspend. And because of this overspending, they will be forced to debase the currency. We'll get into that a little bit more. And here we see the purchasing power of the US dollar against the silver content of the denarius. You can see that it mirrors what's already happened. And I think the end game is the same as well. The lesson of history is what causes declines in a currency's purchasing power. Simply put, it's spending and debt creation. Now, the lesson today is that we've entered the end game of what I believe, and I hope to show you today, is a 45-year process of ever easier money that has repercussions which are being felt right now in commodity prices and other developments. This is the chart, in my view, that tells it all. It's a little bit complicated, so let me explain it to you. The blue line is the federal funds rate. That's the interest rate that the Fed sets to set interest rates across the yield curve. Now, this chart goes back to 1980 when Paul Volcker, as Fed chairman, was trying to kill off inflation. In the process, he raised interest rates to over 20%, effectively killing off inflation as he had hoped. Now, what we see is that whenever there was an economic slowdown, in particular a recession as marked by these gray lines, we can see that the Fed responded by lowering interest rates. initially from those ultra high rates, but then trying to get it in a normal range. Once they got it in a normal range, they continued to lower rates whenever there was a recession or even the fears of a recession. I've used red lines to mark the bottoms of these interest rate cutting cycles, and you can see it's an ever lower stair step from heights down to the basement or down to the foundation, where post the great financial crisis in 2008, we got to zero. We tried to raise rates back at that point, but then COVID came along and we lowered rates right back to zero again. We have tried to raise rates again and largely succeeded this time, getting them over 5% on a Fed funds rate, but are now lowering rates again. And we'll get into that in a bit. But again, this is a 45-year trend of ever lower interest rates, ever easier money. So what does that do? That brings us to the red line. Ever lower interest rates, ever cheaper money encourages ever greater debt accumulation. And as we see here, that red line, the federal debt has soared, just as interest rates have kept plummeting and kept going over that long-term trend line. What does that mean? What are the implications of this rising debt? This chart is a little complicated as well. The red line, again, is the federal debt, and we see it going over, in this case, over 32 trillion. The Federal Reserve actually doesn't update the federal debt numbers on a very regular basis, so this chart seems to be a little bit out of date. But if you look at the blue line, this is the interest costs, the cost of servicing that debt. And you can see after the great financial crisis, if we earned in 2008 through 2010, 2015, and the like, the cost of servicing the debt, even as the debt was rising, the cost of servicing that debt wasn't rising very steeply at all. That's because we were still in a zeroed interest rate environment. Interest rates, as set by the Federal Reserve, were managed to a zero bound. And with low interest rates, the cost of servicing the debt, even though the debt kept rising, those costs were relatively low or did not rise as quickly. But look at the end of that of the chart. Look at what the blue line did as the Fed began to raise rates. The cost of servicing that debt soared. This shows the tremendous leverage that interest rates have. When debts have risen to this level, even relatively small increases in interest costs explode the cost of servicing that debt. Now, this is a chart that, or a graphic that many of us are familiar with. This is the regularly updated, constantly updated, in fact, debt clock that you can find on the internet. As of yesterday, it was a bit over $37 trillion in debt. Now, that's a lot. That's a lot per citizen. That's a lot per taxpayer, as you can see by these other numbers. But I'd like to draw your attention to those circled numbers at the bottom. You can see that in 1980, when Paul Volcker was reigning at the Federal Reserve, the federal debt to GDP ratio was a little under 35%. That meant that Volcker could raise rates. He had the freedom to raise rates. Today, Powell does not have the same toolbox that Volcker had. Now we have the debt to GDP ratio of about 124%. That means that Powell just doesn't have the same toolbox that Volcker has. He cannot raise interest rates, or he can't leave interest rates where they are today, or the federal budget collapses. Right now, again, we're paying over $1 trillion in interest costs on the federal debt each and every year. That in turn, that money is borrowed, which then adds to the debt and the deficit. So it is a vicious cycle. It is, in effect, a debt trap that the Federal Reserve is mired in. This is a representation of what that federal debt, or actually the interest payments, the cost of servicing that debt, has done over the years. As you can see, it is exploding out of sight with interest rates at the current levels. And it's not going to get any better. This year alone, the Treasury has some $10 trillion of debt to refinance. This is why things are getting critical right now. This is why, despite the fact that Powell doesn't want to look weak in light of President Trump clamoring for interest cuts, Powell doesn't want to cut rates, but he really has to. From a fiscal standpoint, we can't afford rates to be this high. Give him credit. In this case, President Trump is absolutely correct. He's mentioned this fact that we can't afford to service the federal debt with rates this high. So we've actually seen the Fed start to turn toward easier money. So the bottom line of all this, and this takes a little bit of thought, so let's go about it a little slowly. The rate of inflation, which is another word, another term for currency depreciation, that rate that your currency is depreciating has to be greater than the rate of interest on the debt, or the entire house of cards collapses. What this means is that we have to have, with this kind of a debt load, we have to have negative real rates going forward. Again, interest rates have to be below the rate of inflation. You have to depreciate your currency more quickly than you're paying interest on that debt. This is tremendously bullish for commodities and real assets of all kinds. Now, most people look at this and say, well, this is immediately obvious that this is bullish for gold and silver as monetary metals. But it is, in fact, bullish for all commodities because it eliminates the holding costs. And it makes real assets, everything from commodities to real estate, real things as opposed to financial assets. It is enormously bullish for those sectors. Now, where are we now? We've seen as of last Friday that things have changed. Despite persistent inflationary pressures, the Federal Reserve and other central banks, again, this is not just a US story, it's not just a US dollar story. Central banks across the world are in the same position. They will be forced to lower rates in the face of these unmanageable debt loads. Now, last Friday, in his speech at the Jackson Hole Central Bank gathering, Jerome Powell already signaled a return to easier money. And Powell's term as Federal Reserve Chairman will end at some point next year. I believe it's ending in May. Trump will have, at that point, most likely or possibly a majority on the Federal Reserve Board and a new Federal Reserve Chairman in place. You can bet that they are going to be lowering interest rates and taking their orders from Washington, from the White House to do so. So although we are looking at in September an initial rate cut, we are actually entering a new, easier money environment going forward for years to come. So that's the monetary debasement factor. What about the supply-demand factors that I alluded to? Simply put, what we're seeing in commodities across the board are strangled supplies, again, facing off against soaring demand. The reasons for this are decades of underinvestment. Big mining companies have been hoarding their cash. They have not been reinvesting in exploration and development of projects. Permitting and other development delays. I have a stunning chart coming up that shows how dramatic those have been. It is so much more difficult to develop a mine today, not just from capital being diverted into other sectors over the years, but permitting and environmental permitting and environmental studies, NGOs, non-governmental organizations that are trying to stymie projects across the world. The end result has been dramatic delays in developing very economic projects and delays in developing any projects across the board. There are supply deficits in these commodities, even for base case demand, if you look across the, and I'll have a chart on this in a moment, if you look across the spectrum of commodities, you see that if you don't factor in new sources of demand, even at base case demand scenarios, we are in supply deficits. Now we get to the dizzyingly steep demand curves for base and energy metals due to electric vehicles, artificial intelligence data centers, renewable energy, the rebuilding of the global electrical grid, and many more factors. This demand curve, simply put, is the steepest we have seen in history across the board. For gold, we're seeing soaring demand from, of all places, central banks. Now, these are the organizations that were actually selling gold in the 1990s and going into the 2000s. Now they are buying gold hand over fist for a number of reasons, one of which is what I just talked about, the debasement of currencies across the board due to the debt loads, largely and primarily with the US dollar, but also because of the dollar weaponization that we saw, most pronounced when Russia invaded Ukraine. We saw a number of very strict sanctions being placed on Russia by the US and its allies. But even those allies know that that gun is powerful and can one day be turned against them. So they have been buying gold hand over fist. In addition, we have long lead times in any market. When you have higher prices, then you see the cure for higher prices are higher prices themselves in commodities, because those higher prices stimulate further supplies. We have a lot of impediments to further supplies in commodities right now, and we'll get into some of those. Let's look at some examples of what's happening. Copper supply and demand. That gold or copper area bar at the bottom shows the annual copper supply up to 2050. Now, as you can see, it doesn't grow that much because of all these impediments to copper supplies. Yet copper demand right now, as you can see at the beginning of this chart, 2023, 2024, 2025, we are already in a supply deficit. There's already not enough copper supply to meet demand. And that supply gap is growing and growing as we see these other factors come to bear. Lithium's the same way. Now, lithium supplies can respond to the demand to some degree, but still they will remain in a structural supply deficit going forward. Now, this chart shows copper mine lead times, and this gets to what I was saying about permitting delays, development delays. As you can see over the years, these delays in lead times to go from discovery to production have grown and grown until by 2030, in some cases, we will be approaching, for some projects, as much as 35 to 40 years between discovery of deposit to its actual development into a mine. This is due to permitting issues, as I mentioned, other delays, but also most copper projects are enormous. They take a lot of development time, a lot of build time, and because of that, and because of the impact they have on the environment, permitting sometimes is virtually impossible, or has been. This is an interesting chart showing the growth projections for critical minerals demand in 2040 relative to today. So that's only 15 years from now. We see that there's a tremendous increase in demand for lithium. This again is for, or obviously is for, lithium batteries and the like. Now, the green bar shows the current status quo. If nothing changes, stated current policies, this is the growth in demand that we'll see. If we see additional demand from the net zero emissions goals by 2050, the yellow bar represents that added demand. Now, I think we're only going to see a fraction of that added demand. I don't think we're going to see a real global move toward net zero emissions as many as envisioned a couple of years ago. Still, we're looking at tremendous increases in demand across lithium, graphite, nickel, rare earths, cobalt, and copper. Now, if you look at the copper bar, I think, in my opinion, that's understated. I think we're going to see much greater demand from copper. And frankly, I think copper is one of the safest and surest ways to play this new commodity supercycle. I think that's one of those investments you can set it and forget it and come back in a few years and you'll be very happy with what your investments have done. Now let's look at gold. Again, I mentioned that central banks have been buying gold hand over fist. This chart is only updated through 2023, but 2024 actually increased over 2023. This year, in 2025, we're actually falling back a bit from those record levels. We are not quite over, probably won't get quite over 1,000 tons of central bank demand this year. I think partly that fallback in demand is due to simply dollar cost averaging. I think central banks are buying on a programmatic basis. They are devoting a certain amount of funds every month, every quarter toward gold to build up their gold reserves vis-a-vis the dollar. And as the gold price rises, they are simply buying less tonnage with that amount. So looking forward, I think that central bank demand will remain pivotal to the market, but I think rather than driving the price higher, it's going to support the price. Now, this is the end result of, or the trend that's resulting from this, this tremendous demand from central banks for gold. These are international reserves. These are central bank reserve mixes, and the dollar share, which is the red line, versus gold share. Now you can see back in the 1800s and early 1900s, gold was a primary component of central bank reserves. Makes sense. We were on a gold standard. But then after 1930, when gold was removed from the gold standard in the US, essentially was abolished, we see that gold share dropped and the dollar share rose. Look at the end of that trend line, particularly since 2015 or 2013, when central banks really started buying gold at a much more voracious rate. You can see that the share of international reserves is rising for gold. And what are they exchanging that for? What are they exchanging for that gold? They're exchanging dollars. You can see that the dollar share of international reserves is falling. Now, it'll be a while, I think. I don't think those lines are going to cross anytime soon. But the trend here is important. Gold's importance as a global reserve is growing, and the dollar's importance is falling. I don't believe that we're going to see the dollar lose its international reserve currency status anytime soon. I don't think that's something we should really bet on right now, but the trend is clear. Gold is rising, the dollar is falling, and you want to be on the side of the rising trend. One of the things that's happening right now is that, or to put this gold bull market that's about 18 months old in a nutshell, is that central banks have driven the market much higher. Now, the Western investors / speculators have been largely uninvolved in this market for much of that time. What we're seeing now is that they are starting to come into the market, and that's evident here with the GLD gold ETF. This is a paper representation of gold, and it's very liquid, and we can see that, and it's also a good proxy for Western investor buying in gold. We can see that that has been rising so far this year. So Western investors are coming into the market. But also interestingly, they're coming in via two sectors that have been lagging. One of these is mining stocks. Mining stocks, this is a chart, shows the GDX mining stock index divided by gold itself. When this line is rising, the gold stocks are actually outperforming, rising more quickly than gold itself. Now, since August 1st, that's really taken off. Central banks don't buy mining stocks. but Western investors and speculators do. This shows that they are coming into the market right now and seeing the gold price having advanced so far, are trying to leverage that and get exposure to gold through sectors that typically outperform gold and have lagged gold to this point. And here again, we see the mining stocks rising as a result of that. Interestingly, even though many of the major miners have doubled in price over the last year, they remain on a price to book value, price to net asset value, price to earnings ratio. They remain at near all-time lows. So they are dramatically undervalued, even though they have advanced considerably. So prices are beginning to rise across the board in all of these sectors. And I think these are creating what I call generational opportunities, opportunities we haven't seen the likes of which since the early 2000s. Critical metals are having a significant breakout from a sideways trend. Copper has been rising. Now look at the end of that line and you see a dramatic drop. We'll zoom in on that and see what in the world happened there. Well, that was President Trump's imposition of tariffs on finished copper goods. Caught the market by surprise, and we had a very dramatic drop in the spot price or global price of copper. Interestingly, we did not see quite the reaction in COMEX or futures copper, because that copper represents supplies in the US that would not be subject to a tariff. But my view on this is that this is a tremendous opportunity because, again, we have that very steep demand curve for copper. That curve is not going to go away because you can't substitute for copper. In virtually all of its applications, there are no substitutions. You cannot innovate around it. So the demand is still there, and if the supplies are constrained, that only adds up to higher prices in the end. So this is, in particular, is what I believe is a dramatic opportunity in copper. Silver has broken out for a very long time. About 11 years, silver was stymied at the $35 level. It has recently broken out in recent months above that $35 ceiling through that resistance, and now is breaking out to what I believe will be $40 in the short term, and then it will make an assault on the $50 level. Silver offers natural leverage to gold, and it is starting to finally outperform gold. But gold itself has had a hell of a run. If we go back to when this began, March of 2024, the price is up tremendously. But as you can see, we have been trading sideways really since May. We are seeing signs right now that we're about to break out of that trading range. Typically, we have a trading range in the summer, and typically, from a seasonality standpoint, the fall is a very positive period for gold. We are about to, I believe, break out for a number of those reasons. And again, I think the Fed's shift toward an easier money policy will be one of the big catalysts for that. So bottom line, this is another long-term monetarily based gold bull market in gold, like we saw in the 1970s and 2000s. And I'm focusing on gold here to show you what kind of potential we're looking at. Here is a long-term chart going back to 1970 of gold, and the way I count it, 3 previous bull markets, and then now the 4th bull market. If you look at the early 70s, you'll see that gold went up 5.6 times from the bottom to the peak. Then we had a short bear market in mid 1970s, then another run to $850, which took gold from 8.2 times from its bottom to its peak. If you go to the 2000s, you see that gold embarked on an 11-year bull market that went up, in which it went up 7.5 times. Now the bottom that I mark for this bull market is around $1,050 in 2015. if we go up 5.6, 8.2, 7.5 times from that level, we're really talking about a $7,000 or $8,000 gold price at the end of this secular bull market, whenever it may occur. There's an alternative interpretation, though. If you look at the red number there, a lot of people lump the 1970s into one long bull market. If that's the case, then we have about 24 times from the low to the high in the 1970s, which gives you even more explosive potential for this bull market. Now, how could we get to that level? If the US gets to some point where we need to establish or reestablish some credibility in the US dollar, at some point in this cycle of ever easier money and repeated blow-ups, repeated bubbles bursting, and repeated rescue efforts by the Federal Reserve, if we get to a situation like that, where to restore credibility in the US dollar, we have to reattach it to gold, some backing by gold at some level. Then you see just backing M2 at 20%, 40%, not even 100%, we get to levels, gold price levels of over $20,000 to do so, to reestablish that credibility in the dollar. That's the possibility. I'm not here to predict that, but again, we have to recognize the important trends, the growing importance of gold, the trend of the federal debt, which is proven unsolvable. It's always growing, continues to grow, and the necessity for ever easier money in light of those debts that have been accumulated. At some point, we are going to need, in my view, to reestablish credibility in the dollar through some attachment to gold in some way. And again, that's where we get to these seemingly fantastic gold price levels. One way to play it that we focus on that I focus on in Gold Newsletter is through mining equities. And in fact, I focus in the much more speculative end of the spectrum in the junior mining stocks, which I would not recommend for widows and orphans. Very risky, high potential, but much higher risk. But the results in that area, when you have a rising bull market behind you, can be spectacular. One example, and obviously this is not every stock that we recommend, but one of our bigger winners in recent years was Great Bear Resources, which rose 87 times from the entry price in a Gold Newsletter alert to when it was finally taken out by a major mining company. So that's the kind of potential that is out there, but I would recommend, if you want to get into this sector, again, it's higher risk, higher potential return, but much higher risk. You need to educate yourself. You need to educate yourself by subscribing to newsletters in the sector, like Gold Newsletter, going to conferences like my New Orleans Investment Conference. And I do urge you that if you want to learn more about the sector, go to goldnewsletter.com, download our free Investor's Guide to Gold and Silver. I outline all the best newsletters, all the best conferences, and every way you can invest in the sector across the board. And you can follow me on X, and where I have running commentary. So thank you.